You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Option Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. And the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out optionseducation.org. Now, here's your host, OIC's Director of Individual Investor Education, Joe Burgoyne.
Today's program is a rebroadcast from OIC's webinar program. Every month, we do webinars on a variety of options-related topics. Check out optionseducation.org for more information. Enjoy the show.
Good afternoon, ladies and gentlemen. We're going to get started. We're glad you could join us here for the latest installment of the Options Industry Council's webinar series. My name is Alexander, and I'll be guiding you through today's webinar. Options pros talk put-call parity and more. I'm pleased to welcome our moderator for today, OIC's very own Frank Tirado, who is the VP of Education for the Options Industry Council and a member of the Industry Services Management Team at the OCC. Before joining OIC, Frank was Director of Trader Marketing at TD Ameritrade and led the marketing team responsible for the strategy, planning, and execution of integrated marketing plans. Prior to TD Ameritrade, he was a senior manager for brokerage marketing at E-Trade Financial and led the growth strategy for trader marketing and education. We're pleased to have Frank moderate today's panel discussion on put-call parity. And now, ladies and gentlemen, Frank Tirado will bring you our topic today, Options Pros Talk Put-Call Parity and more. Frank?
Hello, everyone. My name is Frank Tirado. I am Vice President of Education for the Options Industry Council, and I'm excited about the panel we have today. We have a distinguished group of individuals talking about put-call parity, and we have Marty Kearney representing MIAX. Marty was a former market maker at the CBOE and also an instructor at the Options Institute. Dan Gramza is an educator as well as the president of Gramza Capital Management, and he is a world traveler providing education for a number of entities worldwide. And then we have Jim Strugger, who is a managing director and equity derivative strategist for MKM Partners. And our panel today, as I mentioned, is talking about put-call parity. A lot of option traders look at their screens, at their call and put strikes, and sometimes it's hard to make sense of what they see. And this session will kind of peel away some of the layers on what you're seeing on the screen to really understand what's underneath those calls and put prices. We are also going to talk about strategies as well. We're talking about put-call parity and more. So the second part of this session, we'll talk about trading strategies and that you may be able to think about in different market situations. We know that some of you are new to the Options Industry Council, and I just want to make everyone aware that the Options Industry Council, it represents the U.S. Listed options industry. We are celebrating our 25th anniversary as an educator for the industry, and we are also a part of OCC, which is the world's largest equity derivatives clearing organization. And we are looking to, through our celebration of 25 years, you can find much of our information on our website, optionseducation.org. An important part of our house cleaning here are just the disclaimers here. Some of you experienced investors have seen this before. Options are not for everyone. They involve risk and not suitable for everyone. Everyone should receive the risk disclosure document, characteristics and risk of standardized options before trading. You can either get that from your broker or you can get it from our website, optionseducation.org. Also, we're not going to go through any stock examples, but everything that we say today is for educational purposes only. The data that we use, strategies discussed, are for educational purposes only and should not be construed as an endorsement, recommendation, or solicitation to buy or sell securities. So with that said, let's move into the content. And the first thing I want to share with the audience here is a little bit of news with the volume. And this slide is something that we show frequently during our presentations. And this just shows you the option contract volume by year. Last year we had over 4.1 billion contracts traded, but the big news is that this quarter of 2018 was the largest volume in one quarter in our history. 1.37 billion option contracts were cleared in Q1, which demonstrates the utility of options and some of the things that we're going to be talking about. And so we are going into the new year strong, and I just want to start with a question here, and to the panel, and getting into the topic here, is defining what put-call parity is. Dan, Marty, and Jim, just in your own words here, talk about the fundamental definition, starting with you, Dan, of what put-call parity is and what it means to you.
Well, Frank, it's a concept that truly excited me when I first learned about it. And maybe it's because of my background as an engineer, and I like when pieces fit together. And one of the beauties, or I think a beautiful part of options, is that the pieces fit together. And what I mean by that is that if you and I have an understanding of the relationships between calls and puts and the underlying instrument stock, there's a tremendous amount of information it reveals to us. It tells me something about the delta of the options that I'm looking at. It tells me something about the premium that I can expect. It also tells me something about the behavior characteristics as we look at combinations of calls and puts or stock. I find it a tremendous help in gaining insight into the workings of the options market. And I just want to say one thing about that volume number that you mentioned. It's incredibly impressive, but I guess what it says to me from a trading point of view is that those options have validity to the marketplace, or they wouldn't be used. You and I wouldn't see numbers like that if there wasn't something there for people to work with in terms of managing risk or identifying speculative opportunities. I just think that's really impressive.
No, I agree, Dan. I think that when you went into this year, you saw volatility increase a bit. investors and traders were using options to either play defense with hedging strategies or also generating some kind of positive cash flow through selling options in a conservative, smart way. So I agree, the volume number speaks to the utility of options. And Marty, I was just thinking what you thought about put-call parity, and having been a trader on the CBOE floor, what are some of the things that come to mind when you hear put-call parity?
Well, thank you very much, Frank, and it's great to be here. When I first started trading options, my big concern was, how do they come up with these prices? This option is $2 a bid, it's offered at $2.10 or whatever. How do they come up with these prices? Okay, when puts were added, when I first was on the floor, by the way, the 3 stocks I traded did not have put options back in the dark ages. Okay, but anyway, when put options started trading, there's a relationship between the calls and puts, and it made so much sense for everybody. There is a relationship. And most people, most investors think, well, I'm going to buy a put on XYZ or a call on ABC. You know what? The calls and puts are first cousins. There is a relationship there. And professionals, many times, when you do one trade with them, they may hedge by using the opposite product. You buy a call from them, they may go buy the put and buy the stock. So there is a relationship, and it makes so much sense. And that's why you'll see many, especially in the front months, you'll see nice tight markets on the calls and the puts. And it's that the professionals can sell you this particular option or buy this option from you because they have a very easy way to hedge it because of the relationship between the calls and puts.
Well said. And speaking of professionals, Jim, I know that what you do is more on the professional level, institutional level, and I wanted to really bring that perspective into this conversation to give our individual investors and traders out there just kind of this whole view. And just in what you do day to day, Jim, how do you view put-call parity from your world?
Well, first, just to sort of echo, I think, what Dan said, on the engineering front, I'm an engineer by training too, and I had the same probably epiphany at some point early on where you realize the math that underlies options. And I think there's a certain comfort to that put-call parity exists. Otherwise, I suppose we'd all be, flapping around without having that math underpinning the pricing of options. So I would say it's critically important. When I think back to graduate school, I took every derivative class that they offered, and it all feels very theoretical until you put it in practice. And so it's critical to understanding put-call parity in terms of pricing options. What I would say from sort of an institutional desk, and we as a firm face just institutional investors, so hedge funds, real asset guys, real money guys, so generally across the board large asset managers. And what's interesting is that for us at this level, for my traders, of course put-call parity is always critical for anyone trading listed options. It's embedded in their thought processes. I was talking to one of my traders today about it and just asking him about, what he thinks of. And when I say put-call parity, he thought back to his training days. And a lot of times for many firms, less so these days because the world has changed in terms of, microstructure of how options are traded. But, first job for someone on a trading floor would be for some to just calculate put-call parity all day long. That was their job, amazingly. Clearly no longer done. Clearly their computers are behind everything. Marty mentioned how tight markets are in many, many single name and ETF and index products. And so I think what's happened is that from a desk like ours, a lot of times our conversations with clients don't necessarily involve, or I would say incredibly rarely would involve, put-call parity and the actual pricing of it, because we're much more focused on an underlying, on a volatility surface, however that sort of masks the critical importance of knowing that it exists. And again, at the trading level, you just can't trade listed options without having, a deep understanding and appreciation for put-call parity.
Yeah, I agree. That's well said, Jim. And sometimes it can appear more complicated than it is. And that's what we're going to try to do, is break down this underlying important concept behind the relationship among call premiums, put premiums, and the value and the price of the underlying. And Marty, I know that you wanted to share a slide just to kind of just demonstrate that, and maybe we move into that now to kind of show our listeners and viewers of one way to kind of look at a screen through a different lens and understand what put-call parity is when they're looking at call and put prices.
Yeah, thanks, Frank. And this is a stack, and the stack is not important. Okay, we're not recommending any stacks, long or short. Okay, we're not recommending any strategies. It's up to you to decide what you'd like to do. But here's a stack, and the first circle that Frank's going to pop up here is going to show the stack price of $30.14, and I'm taking a look at the 30 strike price call. Now I'm looking at the June 1st call option. Okay, you can see June 1st up on the top, 23 days from June expiration. So this was a little over a week ago, I think, that we took a look at this particular strike price. Okay, and I'm taking a look at the next slide here will show you the 30 strike price call and put offers. Okay, now take a look at that. The call option is offered at $1.78, and I'm going to use some rounding here, so don't worry, okay? The put is offered at $1.60. Pretty tight markets, okay, going out a couple of 3 weeks before expiration. So why would the call trade for more than the put? Well, take a look at the top. The stack is trading at $30.14. And if you were to take, and this is where the math that both Jim and Dan talked about comes into play, if you were to take the price of the call at $1.78, subtract the price of the offer on the put of $1.60, you'd come up with 16 cents. So the call costs 16 cents more. I'm sorry, 18 cents more. It's not what I say, it's what I mean. 18 cents more than the put. Well, guess what? If you were to take a look at the cost of carry, meaning if you were to, rather than buy the stock, if you were to put the money in the bank, $3,000 on 100 shares for 21 days or 22 days until expiration, 23 days, all right, what you would find is that you'd get about 3 cents of interest. So the cost of carry, interest rates are embedded into option prices. So this means that, this call and put, they are lining up exactly as the math would tell you they would. And remember, we're looking at bids, offers, etc. But using offer, this is what it would line up to do. So the calls should be trading at a higher level than the puts, all things being considered, if interest rates are above zero, and they are. The interest rates on 21 days is probably about 1.25%. It's not very much, okay? But the next slide, we take a look at, when it comes up here, we're going to take a look at the implied volatility. Now, the implied volatility for, in this case, whether it's optionseducation.org or whether it's your own broker's website, they're taking the midpoint of the bid on the call and the bid on the put, and the midpoint on the bid on the bid and ask rather on the call and bid ask on the put. So what we're looking at here is the implied volatility midpoint, 55.2 on the call side, 55.13 on the put side. That's as darn close as you can get. Okay? So what we're saying here is that, guess what? Implied volatility doesn't point to higher or lower. It just talks about what kind of a move should we be making or could we make based on the pricing of these options. And you know what? The implied volatility on the call side and the put side, it's pretty much the same. So once again, we're talking about the call-put parity, the relationship between the call and the put. And if we were to scroll down to the next slide, the next slide on this, we're going to take a look at, what are we going to take a look at on the next one? We're taking a look at the 30 call in July, which is 72 days from the day that we pulled this up. All right, and if we take a look at the offers on the call and on the put, for the call for these options, the 30 strike price call. You know what? Now this is fairly unusual. Take a look at this. The call is offered at 223, and the put is offered at 231. Now you would think that the further out in time we go, the call will become that much more valuable than the put. But here's the kicker, okay? If you take a look at when the dividend is paid, there's a 38-cent dividend payable on or about June 14th for this particular stock, XYZ. I don't know if it's been officially determined, but that's kind of when everybody thinks the dividend will be paid. So you know what? The call option is taking a look at the stock at 30.14. The put option for July is taking a look at the stock trading 38 cents less. Okay, so it's trading at 29.76 or whatever that is. Okay, so this is where once again there's a relationship. The calls and puts are related, but the call is looking in July at the actual price of the stock today. The put is taking a look at the price of the stock the day after the dividend when the stock is moved down. If you're not familiar with that, if you're new, if this stock is right here at 30.14 and it closes today at 30.14 and it goes ex-dividend tonight, the owner of 100 shares, let's say, would still own 100 shares. They would be entitled to a 38-cent dividend, but the stock price would be moved down 38 cents. Okay, so they would be whole, wouldn't they? They still have 30.14, 38 cents, and 38 cents less than 30.14 to give us the price of the stock. So once again, the calls and puts are telling you something. Okay, and the next circle we'll take a look at, and I think this will be just about the last one, is that we'll take a look at the implied volatilities for these July 20th strike price calls and puts. Now look at that. The call implied, this is the midpoint, and that's a 2-cent wide market. That's nice and tight. Is a 42.56. On the put side, the implied volatility midpoint is 42.37. Once again, the July options are trading at a much lower volatility. Okay, but you know what? They are, once again, they're first cousins, aren't they? There is a relationship between the July call and the July put. And if you take a look at the implied volatilities, going back up, staying on the same slide, why would the June 1st options be trading at a higher volatility? It's trading 13% higher. Percentage-wise, that's what, 20% or so, isn't it? The reason being that this particular company, up on the top, we don't have the circle, but there's a little blue E up there when we're taking a look at the different expirations. This company had earnings on the afternoon of May 15th or the morning of May 16th, okay, and obviously the uncertainty is reflected in shorter-term options to a much more greater extent than the options further out in time. So that's why the implied volatilities, they change all the time, but a lot of it is expectations, isn't it? So I think this is a very, very interesting slide. Did we have one more thing on this, Frank? I'm not sure if we had something on. No, that was it. So you know what? I think what you should do is, go to optionseducation.org and look up the term long, L-O-N-G, conversion, and you should look up the term short conversion, which is sometimes shortened even further to the term reversal. Okay, and the long conversion just says, if you buy a call option from me, let's go back to that one in June, okay? If you buy the June call at $1.78 from me, right next to that 55.20, and I'm a trader, I may sell you the call. Now I'm short. I may go buy 100 shares of the underlying, but to protect myself now, I will go buy the put at $1.60. That's the long conversion. Okay, so you buy a call option, and I go into my workshop and actually manufacture one. Okay, and the reverse conversion, I'll talk quickly, we've got a lot to cover here, but the reverse conversion is you buy a put from me, I will sell you the put, I will buy a call, and I will short the stock. But once again, this all takes place with call-put parity. The calls and puts are in line with each other, and it should pretty much always be that way. Okay, Frank?
Yeah, thank you, Marty. That's very insightful. This slide was interesting to show the relationships between the prices of the calls and puts. But Dan or Jim, any thoughts on this, or any of the comments that Marty has made?
I would just reiterate the importance of what he just went through, because I think it's worth its weight in gold. First of all, to look at an option montage, this is what most people see. Some of it's use a Bloomberg or something similar, but at the end of the day, an option montage is an option montage. And the way that Marty circled the prices strike, underlying price, implied volatility, that's exactly as I think people on this call or otherwise should go about reviewing put-call parity, is pull up option montage and a name you care about on whatever system you use to trade and go through that exact process. And you know what? If you do that just about every time, you're following the path of the vast majority of listed option market makers in terms of their understanding of trading these products. That would be number one. Number two is the point he made about the dividend is critical, because if you go through this math and the numbers don't match, the assumption should not be, ooh, there's an arbitrage. The assumption, I think, at first should be there's something out there. There's a regular dividend, a special dividend. The market is very smart. The market prices in these special events, and it shows up in the option market. So that's another secondary reason to be very comfortable with the math that underlies put-call parity. And then the last point that I would point to, just piggybacking Marty once again, was the comment he made about implied volatility. Not to be understated in any way. That is hugely critical. In this example, you had mid-50s vol in that front month. July was about 13, 15 points lower. Again, the option market is very intelligent. The people that make up the option market are very intelligent. This is most likely never going to be an ARB. This is going to be a representation of an event. The most obvious catalyst that would drive potentially a 10, 15 point wedge in implied volatility between 1 month and another, or one expiration and another, would be earnings. But it could be anything. It could be an analyst day. It could be an event that's less perceptible. Maybe there's a product launch coming. Who knows? But again, that process and sort of systematizing that is what a lot of us do all the time, which is to say, pull intelligence out of the listed option market as best we can, not just looking month to month per se, but looking at one term, looking at discrepancies, looking at term structure, which is out over time. Skew looks at implied volatility from puts to calls at one point in time, but I think that's a great way to think about segueing into sort of the next phase of utilizing options, which is to say, understand the volatility surface and learn how to best exploit it.
Yeah, Jim and Marty, well said and well done. I agree that that's the goal of this session for individual investors and traders out there, to kind of take a deeper look at their screens and understand it at a different level. And Marty, I think your explanations was spot on, and these examples really goes to show the importance of the cost to carry, the importance of dividends, and the pricing of options as you look at your screen. So investors and traders out there, now you have kind of a simple format. When you look at your option chains, you're looking at your calls and puts. You can do a simple exercise as Marty did and compare the prices and the volatilities and extract the information that the option chain is giving you. And I do want to move into another phase of the conversation, and I know that tied into this is this other concept, Dan, of synthetics, synthetic strategies. And I'd like for you to kind of take the lead with the conversation on that and talk about what that means and the importance of that to investors and traders listening in now.
All righty. Shall we move to, when we think about synthetics, what we're looking at is the relationship between call, puts, and stock. And what we're going to see is that you and I can create a synthetic position of a call, a put, and a stock. And it can be a long position or a short position. So let's move to the next slide and see how these pieces can come together. And we're going to start with a synthetic long stock. And what we're going to be doing is we're going to short a put and buy a call. So our first here is we have a short put. Then we have this green line represents a long call. So if we stop and look at that, we know we make money if it goes up to the right, and we lose money if it goes down to the left. Now let's look at the next here, Frank, and that you see is that blue line represents the same profit and loss diagram that you would have if you were long a stock. Also, look in the lower right-hand corner, and what you see is something about delta. You know, we have a short put, so we got a positive delta. A long call, we have a positive delta. The total equals 100, which is what we'd want to see for a long stock position. So let's say, just for a moment, how we would use this. I want to buy a stock, and it's very expensive. So I look at my capital, the efficiency of using my capital, and I may be better off creating a synthetic long stock position as opposed to putting the capital into that particular stock. Let's go to the next slide. And here we're going to be looking at a short stock position. And it's going to be a long call, a long put, and a short call. So here's our long put. We're making money when it goes down. Here's our short call. We're losing money if it goes up, if stock prices go up. And again, if I look at just the summary of what we have here, the next point would give us that blue line, which represents a short stock profit and loss diagram. And look in the lower right-hand corner, look at delta. You know, the long put, well, it's going to be a negative delta. A short call, that'll be a negative delta. And we have a negative 100, which also fits a synthetic short stock position. Let's say that I want to short a stock, but inventory could be an issue, or my broker has to go out and find it to put in, to borrow for me. Here, I don't have to do that. I don't have to worry about inventory if I use a synthetic short stock. So it gives me a tool available to me without, again, going through the capital commitment and the steps necessary to short a stock. All righty, Frank, let's go to the next one. And this is going to be a synthetic long put. So a short stock and long call. All right, here's our short stock. We're going to make money if the market goes down. We lose money if it goes up. A long call, we're making money if it goes up. Now, look at the right side of this diagram. We're making profits with the long call. We're losing money with the short stock. Those offset each other. Let's go to the next point here, Frank. And what we're going to see is what we have is that synthetic long put. And what we're looking at is we make money if the market goes down, and we're fixed on our exposure to loss on the upside. And again, look at the delta. It has a negative delta, which would make sense. That implies about an at-the-money put, right? We're around 50. And it tells us that it's negative, so we're going to make money in this position if the stock price goes down. All righty, let's go to the next one. A synthetic short put, long stock, short call. All right, so let's look at the first phase of this. Long stock, that's a typical profit and loss diagram. Let's add in here a short put. And again, look to the right. You're seeing profit being offset by loss. And that means it's going to be flat. We're not going to have exposure as this market goes higher. And now let's add one more piece here, Frank. There we go. And so now we have a synthetic short put. We're going to lose money if this stock goes down. We're break even, or not break even. Whatever we've earned on this, we're going to make to the upside. And again, look at the delta. It fits, right? So we're looking at a position here that we have a positive bias to it. That's what that plus 46 delta says to us. Let's go to the next one. A synthetic long call. Long put, long stock. So here we are. We have a long put. So we'll make money if the market goes down. And let's take a look at our long stock. We make money if the market goes up. Excuse me. And we lose money if it goes down. Now, if we add those two together, let's go to the next point here. We have limited risk to the downside, right? The profit, again, now on the left side of the diagram, profit is offset by the loss, so that remains fixed. So whatever we would earn or whatever we pay, that would be the maximum loss to the downside, and we make money if this goes up. Look at our delta. We have positive delta. So what we know is this is about at the money because it's near 50, and we also know it has a positive bias. This position will make money if it goes to the upside. I have to tell you, I just love these profit and loss diagrams. They're such a wonderful tool to give us a feel for what's happening here. Let's look at another one. A synthetic short call. Short put, short stock. All right, let's add those on the diagram. Here we have a short put. And again, if we sold a put, we're going to lose money if the market goes down. We're short stock, and we're going to lose money, or make money if the market goes up or down. Excuse me. And now let's add in what these two diagrams represent to us. And what it represents, first, if I look at what's happening, again, on the left side of the diagram, profit is offset by loss, so that remains fixed. And if you look to the right, we're making money because we have a synthetic short call. If the price goes up, we get to keep that. And if you look at this, we lose money if it goes up. If you look at this, it has a negative delta. So that means the bias for this position is bearish, and we really don't want it to go up. We want it to go down to the left. So, and I think this is our last one, isn't it, Frank, or do we have another one? No, I think we
that's the last one. Yeah,
Could I throw in a thought here?
Yeah, please,
yeah.
Murray.
Okay. The one thing you need to be aware of is that on some of these synthetic strategies, you should probably check with your broker to make sure you're approved for it. For example, like if you're short a put and you're long a call, are you approved for short puts? Most of you, I think, would be at this point. The second thing is that be aware that there could be a margin requirement. Even though if you buy the stock, obviously you have to put up, the money for the stock or a certain portion of it. If you're involved with a long call, for example, you have to pay for the long call. There can be a margin requirement on the short put. So just be aware of that. It isn't a freebie. If we're buying a call and selling a put for 18 cents, we're not putting up 18 cents. We're putting up a little bit more than that, and we should, okay, because we have the risk of stock ownership. The last thing I wanted to talk about is when you talk synthetics, some people that are new are thinking, boy, this sounds kind of crazy and kind of, it might even be dangerous. If you took a look at Dan's slide 25, the synthetic short put, you know what that is? A synthetic short put is the covered call. Okay, where we're long the stock, we sold a call option. Synthetically, we have risk to the downside, don't we? So that's synthetically a short put. So once again, a lot of these combinations of calls and puts and stock, you might know them by a different name. This is once again another homework assignment. In addition to learning about the long conversion and the reverse conversion, it's to take a look at some of these synthetics and go, wait a minute, I know what that is. I know it by a different name, and all of a sudden it's not so it's not so unknown. Okay, you know it as something.
It's a good point, Marty, that, the covered call and the short put and other strategies like the protective put and the long call are familiar to our investors and traders out there, and making these connections and to identify how they synthetically can be equal is another way to kind of understand the markets and strategies at a different level. I do want to move on, but Jim, any thoughts on synthetics or any last words before we move on to the next segment?
I think the only thing I would add again is how important all this is. I can tell you that certainly even at the institutional level, there are plenty of clients of ours, large investors who might not be aware of this, who maybe traded options for years and didn't go through derivative classes, didn't make it to floor making markets in listed options. So really all of this is hugely critical to the underpinnings of understanding options. Even the idea that you're long stock and short a call against it. Plenty of people are folks who extract that volatility risk premium, and in some cases not realizing that they're synthetically short a put. So I would just echo the view that this is just really critical information to understand when you're trading and investing using listed options.
I'd just like to add something there. Jim, I think that's a very important point and Marty, you mentioned it too, people back into synthetic positions. And so if they understand these relationships, they understand that profit-loss combination that they may have just created.
Mm-hmm. Yep. Absolutely.
I agree. Well, the title of this webinar is Option Pros Talk Put-Call Parity and More. Let's open it up for conversation, and again, let's talk about volatility and from a historical context. And Jim, I know that you did some analysis before this before this presentation, and it'd be interesting to kind of show what you have provided, some of the slides you provided.
Sure. So just a side note, I started my career on the street in economics and morphed over to the derivative side a long time ago now. But aside from the elegance of some of the math that's already been discussed on here, that was an attraction for me. It was also when I started looking at the longer-term cyclicality of volatility, and shorter-term for that matter, but the underpinnings of volatility mathematically are, at least in my opinion, that the time series are mean reverting and path dependent. So there's a certain mathematical magic to volatility, and with that, we spent a fair amount of time thinking about broad cycles. And the graph that's up right now takes us back to the 1920s. So this is realized volatility, 20-day realized volatility of the S&P 500. And what's notable here is that we've come through in 2017 a year that was the second lowest on record, dating back to 1928. So realized volatility was 6.8%. It was a wee bit lower in 1964, but that certainly is notable. And if we can go to the next graph, this is one that I use and have used for years in the front page of most of my slide decks that I bring to clients. And the reason is because, I think I have a simple mind and some sort of mathematical bias to it, and to be able to draw sort of pretty little boxes around volatility regimes has always been comforting to me. So what are we looking at? We're looking at VXO, which essentially is the predecessor to the VIX. The reason I use it is because you pick up about 5 years of data not available with the VIX. And what we've boxed off here are our view of high and low. Yeah, I'm sorry.
Just the VXO would be the options on the S&P 100, right?
Exactly, that's correct. And so we've boxed off high and low volatility regimes. As you can see, there are 6, at least to my eye, distinct volatility regimes. And way off to the right there, I've put a new box around what I think is the recent beginnings of a new high volatility regime. That box represents just what's happened so far in 2018. Why is it relevant? Well, first of all, there are relationships between volatility cycles, economic cycles, and credit cycles. We don't have a ton of cycles to play around with. There are only 2.5 underlying economic cycles represented in implied volatility data in this graph. But what has tended to happen with the late 1990s is the very best example, is that you get deep into an expansion, and obviously you have the factor of monetary policy tightening, other risk factors that add up and aggregate deep into an expansion. And if you look right in the middle there, that 1996 period, that was a great cycle, right? It began in 1991, so you're 5-6 years into an expansion. Implied volatility in U.S. equities lifts, and then remains elevated for almost 4 years through the remainder of what was a heck of a bull market in the late 1990s. Some of us certainly remember it. Eventually a tech bubble, and then eventually a bear market and a recession. And volatility remained elevated into that new expansion until the expansion was truly sustained. And then, if you will, the floor comes out of volatility. You return to sort of a baseline closer to 11, 12, then sort of 15 or so. And that that representation is critical to understand this sort of cyclicality. And then the last thing I'll say is that, again, if you look back at the beginning of this year, I think that we closed a 5-year low volatility regime dating to the very end of 2012. And I think that, again, we've begun now a new environment, a new regime of elevated volatility. The floor under VIX, closer to the mid-teens than the 9-10 handle that we have seen a few times over the last several years. But it also means that we're more susceptible to shocks, because aside from the summer of 2015, every major volatility event, and with that, every major pullback in U.S. equities dating back to the mid-1980s has been contained within one of these high volatility regimes, and that's really the critical piece. So not only does it inform strategically how people should think about their portfolios, but it also informs strategically what sort of option strategies make sense. If implied volatility is elevated, then those who look to extract volatility risk premium, i.e., for example, selling calls against long stock positions, creates a much more fertile environment for those investors. And there are also other, sort of distortions that come in single stock and ETF and index volatility services in this sort of environment relative to an environment like the last several years when volatility was as low as it is. But, real takeaway here is, aside from sort of the myopic side of options, I don't mean that in a negative way at all, but the pricing, everything else we talked about, understanding that, obviously critically important. But it's nice, I think, to step back and have a broad appreciation for volatility cycles and what that means.
No, that's well said. I think there's layers in what we do here in the options industry regarding strategies, and we talked about put-call parity, talked about synthetics. Now we're talking about volatility regimes that, from your graph, look interesting and clearly a pattern. And then, Jim and Marty and Dan, I'm wondering, when we look at this particular graph, when you think of strategies in high, increasing, decreasing, or flat volatility regimes, what kind of strategy? Just pick a regime, and what kind of strategies come to mind so that our investors and traders out there can kind of connect the dots?
Well, go ahead.
Go ahead, Dan.
Oh, I was just going to say, from my point of view, if I have a feeling that volatility is increasing, and one of the tools I find helpful for me when I evaluate an option position is technical approaches. And so if the technical approach that I'm looking at gives me the right setup, and I am looking for a high volatility situation whether it's an index that we're looking at or an individual stock. Then I wrap parameters around it. The way I do it, Frank, is that if we have this bullish setup, I look at candles, for example. If I have a bullish setup, I do two things with it. One, I limit time and I limit price action. And here's what I mean by that. I'll pick expiration beyond the current, and I will give it 5 days. I'm looking at delta near 100. So I either buy a couple at-the-money options or a deep-in-the-money option. And if it's an upward movement, so calls, it's got 5 days to work. If it isn't typically profitable within 3, actually, I don't think the trade's going to work. The movement I'm looking for is an increase in volatility within 3 days after that technical signal. Now, if I don't get that, if I don't have trade entry or it's not profitable, I give it the big adios, get out of that position. The reason for it, it's expensive. I'm buying time, and I'm buying delta. I'm buying that in the money or delta near 100. If it doesn't work within 3 days, though, I exit that position, take that capital, and look for another opportunity. Or if I feel I have a technical setup that's going sideways, then I look at selling straddles or taking advantage of selling some premium that I can use. And again, I look at a time parameter to do that. What bothers me sometimes when people are looking at just an outright position, which is not what I'm talking about, these are directional positions, is they say it only cost them $500, and they'll just wait and see what happens. To me, that's somebody saying to me, I'm going to donate $500 to the market. I think we have to start out with a strategy, and it's important with options, I believe, that we put a time parameter around it. When do you expect that to happen? And I think that's what technical approaches help me with. So that's the way I would approach it.
Hey, Marty, any thoughts?
Yeah, mine is I'd echo what Dan just said, and mine is even a little simpler too. You know, if I'm thinking I'm bullish, but I think the implied volatility is high, I'm doing a spread. You know, I'm buying what I might consider an overpriced option, even though we just explained it's not overpriced, right? But I'm going to buy an expensive option. I'm going to sell an expensive option. Or I might sell a put, you know, with a high volatility, okay, which is what Jim was talking about with strategies. If I think volatility is low, maybe I'm just an outright buyer with the idea that maybe I can hedge this somewhere down the line in a very short time. But Dan had a very important thing he threw in there, having some sort of a time level. Yeah, I'm putting a position on no matter how you do it, but I'm only giving it X amount of time. You know, I'm not writing this thing until expiration Friday. You know, I have some sort of at least a time frame where I'm going to check this thing and make a decision at that time whether it's worthwhile to hang on to or not.
And you know, Marty, on your idea, I like what you said, is that if I have a directional move, let's say that this stock has come down. There's a couple of things that you and I know. If I have a bullish technical setup, then I know that the puts are going to be rich because the market's been moving down. I know the calls are going to be cheap. So my decision is, do I sell those puts? And again, I need a technical setup that's going to give me, and maybe in this case, 2 to 3 weeks before expiration, so I can capture some of that theta and take advantage of it. Or do I now buy the call, which is going to be cheaper, going back to put-call parity that we were just talking about. And it gives me those two opportunities. So if I'm looking at a weekly chart, I probably want to sell that put. If I'm looking at a daily chart setup, I'd be more inclined to buy that cheaper call at that point.
Okay. I agree.
Yeah, Jim, any thoughts there on strategies and different volatility levels?
Yeah, a couple thoughts. One, I think I mentioned it, but again, if we are in fact in an environment of structurally elevated implied volatility, then I would imagine a strategy that's probably most near and dear to listeners' hearts would be extracting volatility risk premium. Again, just in most cases anyway, selling calls against existing put positions and taking that premium out of the market. Of course, you can also sell puts against short stock as well. That's effectively an equivalent strategy. So that's number one. That becomes more attractive. in this sort of environment that I imagine going forward, certainly relative to 2017 and the prior few years. And then I think, as Dan mentioned also, that skew, if skew is elevated, and again, in an environment where we would imagine, late cycle, potentially more risk, higher implied volatility in equities, you could also imagine that skew would be more elevated on a sustained basis. And by that I mean put implied volatility elevated to call implied volatility. In the option montages earlier, the calls and puts had implied volatilities that were pretty near each other, and certainly that happens. But what more traditionally happens is you have the volatility smile, which is that puts, because they provide protection or insurance effectively, tend to see higher implied volatility than call implied volatility, and especially in the environment, at least that I imagine going forward, that could be the case. So again, if you have steeper skew, how do you exploit that? One way would be to sell those puts, perhaps turn around and buy calls for risk reversal, effectively constructing a long delta position. In that scenario, you could potentially also do other things with put spreads and take advantage of just the steepness of the put skew. But it really crosses over into the critical element of what that volatility surface looks like and how to exploit it.
Yeah, and that's a good point, and I do want to emphasize the importance of being careful with selling options, and I was just thinking of Dan or Marty, any final words about just for investors out there, if they're thinking about selling premium, the importance of being covered, and talk a little bit of that on whether or not that particular part of it, meaning being covered, is very important as you look at short selling premium.
Yeah, I keep my short premium pretty much on the short side. There's so many different stocks and baskets of stock these days that have not only the monthly options, but they have weeklies as well. That you can go out 5 or 6 weeks and there's an expiration every week almost. So I don't like to sell options that much further out in time, because you might be right, and then it's like watching paint dry, while you're waiting for the clock to keep ticking and ticking. So I don't like to go out more than traditionally maybe about 30 days, just because I don't want that time something happened to hurt me. I want that time to work for me. But that's one of the things I'd be very careful with short-term options, or with any option. If you're a seller, keep it short.
Yeah, Marty, I totally agree with you. I was just going to say, Frank, or did you want to go to something else?
Go ahead, Dan.
Oh, I was just going to say I totally agree. If you and I sell premium, especially if it's naked, I have very tight controls around it. First, I don't take any risk with it. If it's back at my level where I sold it, chances are I'm now considering getting out. I want limited risk on that, because it can be volatile. It could pick up risk that I wasn't intending on doing. So if I'm going to do that, again, I put strict parameters around price, so I limit my exposure in that regard, and then also the time factor. We want it where theta can be our friend, and that's that last month or so, 3 weeks, that really helps us.
Yeah, and to Jim's point earlier, if you're selling calls, you want to be covered with the stock, or you're selling puts, you want to be collateralized with cash, so you can be totally safe in generating that positive cash flow. I know we have about a minute to go. Alex, I know you have some things to say in the out, but I do want to thank everyone on the call for your time. Today we went through a lot of interesting concepts regarding options, and the one important point is that this particular webinar will be available on demand. And thank you for your attention, and and Alex, you can take it away with your outro.
Thank you, Frank, and thank you to our panelists. And ladies and gentlemen, thank you for your time today. While we weren't able to get to all your options questions, we do have our investor services team ready to help. Feel free to reach out to them at options@theocc.com. That's options with an S at theocc.com, or click the Contact Us widget at the bottom of your screen. Many of you asked about further education. Please visit optionseducation.org and see the Getting Started section for further reading. You can also access OIC's MyPath assessment to gauge your options knowledge and receive a custom learning program for you to advance your investing skills. And of course, make sure to check out our website for upcoming events. Our next webinar will be the OIC Summit, which Frank mentioned earlier in today's broadcast. The summit will cover fundamental and technical analysis and how investors can utilize these different approaches to build their investment strategies. You can register and learn more about the summit by clicking the register link or visiting our website. We have a very nice lineup of webinars for the summit, which will be on Wednesday, June 27th. And finally, please tell us what you thought about today's webinar and topic by filling out the survey, which you can access using the widget icon below. And with that, thank you for attending, and we hope to see you again next month.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email Joe Burgoyne at options@theocc.com or visit optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at optionseducation, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.